Greg Abel inherited $397.6 billion in cash and chose to deploy more of it into Google than into any other single direction. That asymmetry is the anomaly this analysis investigates. The consensus reading is straightforward. Berkshire tripled its Google stake to roughly 58 million shares, making it one of 5 largest positions at $16.6 billion, and the market treated it as validation. But that reading skips the harder question. Abel simultaneously exited Amazon, Visa, MasterCard, and United Health, collapsing the portfolio from 40 holdings to 26, which means Google wasn't just added, it was chosen over the rest of Berkshire's entire prior framework of compounding businesses. The exits matter more than the entry. Visa and MasterCard were classic Buffett-era moat plays, high return on equity, capital light, nearly recession-proof. Cutting both while tripling Google signals that Abel isn't simply diversifying into tech, he's re-rating what qualifies as a durable moat. That re-rating is the capital flow story, because institutional allocators who shadow Berkshire's 13F now face a framework question, not just a position question. What Abel signaled is that $64.4 billion in trailing free cash flow and $126.8 billion in cash on Google's balance sheet clears the Berkshire bar for capital preservation, and that the cloud operating income tripling to $6.6 billion in a single year clears the growth bar simultaneously. That dual qualification is what Berkshire described as defensive and growth-oriented, a phrase that almost never applies to the same asset in their vocabulary. The 38% Google rally since Q1 end confirms that it repriced on the signal before most position watchers finished reading the 13F. Abel also bought $15 million of BRKA with his own capital in March 2026 and pledged his entire salary to further purchases, meaning the Google bet and the personal conviction bet were placed in the same quarter. That coincidence isn't narrative decoration. It tells allocators that the framework shift is personal and durable, not a committee hedge. The question it leaves unresolved is whether the asset Abel bet on, Google's cloud, can sustain the re-rating at the velocity the market has already priced in.
The $462 billion cloud backlog is what makes Abel's re-rating load-bearing, but the structure of that backlog is what the consensus hasn't fully priced. Anthropic's $200 billion commitment to Google Cloud infrastructure is the largest anchor contract in Google Cloud history, and Anthropic is the most strategically significant counterparty that contract could have named, because Anthropic's own valuation and growth depend entirely on inference compute at scale. That dependency runs in both directions. Anthropic needs Google Cloud's TPU infrastructure to run frontier models at competitive cost. Google Cloud needs Anthropic's workloads to justify the $175 to $185 billion in 2026 Capex that is currently compressing Google's free cash flow by 46.6%. The $200 billion commitment converts what looked like a discretionary infrastructure bet into a contractually anchored revenue ramp, which is why the backlog nearly doubled to $462 billion, even as Capex doubled. The counter-signal worth holding, that free cash flow collapse from prior levels down to $10.1 billion in Q1, is the threshold variable that separates the bull and bear cases on Google. If the cloud backlog converts to revenue recognized faster than Capex peaks, free cash flow recovers, and the $16.6 billion Berkshire position looks cheap at a 28 forward PE. If Capex continues to scale without proportional backlog conversion, the same PE becomes a ceiling rather than a floor. The Anthropic deal matters precisely because a $200 billion committed counterparty compresses the conversion rate uncertainty. The spend is no longer purely speculative infrastructure. Gemini processing 16 billion tokens per minute through the API, up 60% in a single quarter, is the operational signal that consumption is already scaling against that infrastructure. The 350 million paid Gemini subscribers represent a second revenue stream that doesn't appear in the cloud backlog, but runs on the same compute. What this configuration leaves unexplained is whether Google's custom TPUs, the infrastructure Anthropic is paying $200 billion to access, actually displace NVDA in the AI compute stack, or merely reduce Google's own dependency on it.
Google briefly surpassing NVDA in after-hours market cap after a 160% one-year rally isn't a milestone. It's a valuation question dressed as a headline. The market cap crossover only matters if it reflects a genuine shift in which company controls the AI infrastructure pricing power going forward. Google trades at a 28 forward PE against NVDA's 24, which means the market is already assigning Google a growth premium over the company that currently supplies most of the world's AI training chips, and that premium rests entirely on whether the cloud backlog story is real or aspirational. The TPU optionality is the reversal card most commentary has underweighted. Google's custom TPUs are not just a cost reduction tool for internal workloads. They are the specific infrastructure Anthropic committed $200 billion to consume. If TPUs become the preferred inference substrate for frontier AI labs, NVIDIA's data center revenue faces a structural share loss scenario that has nothing to do with demand for AI broadly. That would invert the current valuation logic. NVDA at 24x forward earnings assumes continued dominance of the AI compute layer, but Anthropic paying $200 billion to a TPU-native cloud is a data point against that assumption. The antitrust overhang removal from last September's landmark ruling clears a second re-rating pathway. Google had been trading with a regulatory discount embedded in its search revenue multiple. Removing that discount allows the 19% search growth to be capitalized at a higher multiple, simultaneously with the cloud re-rating. Two independent multiple expansions converging in the same earnings cycle is what drove the 160% annual return, and it's also what makes the forward PE of 28 less alarming than it appears in isolation. The unresolved fork is Capex trajectory versus margin recovery timing. If Google sustains $175 billion to $185 billion in annual Capex through 2026, while the cloud backlog converts on schedule, the Berkshire position at $16.6 billion looks like early cycle infrastructure positioning, the same logic that made railroad investments look expensive until freight volume proved the rails. If backlog conversion lags and free cash flow remains compressed below $10 billion quarterly, the 28x PE erodes faster than the rally suggests, and Abel's framework bet gets tested against the same cash flow discipline that defined Berkshire under Buffett. The benchmark Abel introduced, Google as simultaneously defensive and growth-oriented, only holds if cloud operating income, which tripled to $6.6 billion in 1 year, continues compounding at that rate through the Capex cycle. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.